In 1979, an economist walked into the Oval Office and told the President of the United States he was about to deliberately crash the American economy. Within 18 months, unemployment hit 10.8%. Construction workers couldn't find jobs. Car dealerships closed by the thousands. Farmers lost their land. The prime interest rate reached 21.5%. Homeowners paid more in interest than their houses were worth. And through it all, one man refused to blink. His name was Paul Volcker, and he did something no central banker had ever dared. He chose economic destruction over political survival. The numbers sound impossible today. Mortgage rates, 18%. Inflation when he started, 13.5%. By the time he finished, he'd triggered the worst recession since the Great Depression. Construction industry employment dropped 30% in less than 2 years. More than 150,000 businesses failed. And here's what nobody tells you. He knew exactly what would happen before he started. By 1982, the dollar had become so unstable that foreign governments questioned whether to keep holding the U.S. Treasury bonds. Gold prices had exploded to $850 per ounce as investors fled paper money. The entire post-World War II economic order hung in the balance. This is the story of how one tall banker broke inflation and reshaped global central banking. The most powerful central banker in modern history grew up in a household where every penny mattered. Paul Volcker's childhood wasn't marked by poverty, but by something equally formative: Depression-era caution. His father, Paul Sr., managed the finances for Teaneck, New Jersey, a middle-class town across the river from New York City. Every night at dinner, young Paul absorbed lessons about fiscal discipline that would later define his approach to the Federal Reserve. You see, his father didn't manage Teaneck like a politician seeking popularity. He managed it like a family budget, carefully, conservatively, with deep skepticism toward debt. When town residents demanded new services, Paul Sr. showed them exactly what it would cost and asked if they were willing to pay higher taxes. No borrowing to paper over hard choices. No promising what the town couldn't afford. This philosophy sank deep into young Volcker's consciousness. Years later, when critics accused him of caring more about inflation than unemployment, they didn't understand that Volcker viewed inflation itself as a moral failure, a government breaking its promise to preserve the value of citizens' savings. The Volcker household spoke German at home. His mother, Alma, brought old-world discipline and a distrust of anything flashy or speculative. The family lived comfortably but simply. No extravagance, no showing off. Paul wore the same rumpled suits throughout his career, not because he couldn't afford better, but because his upbringing taught him that appearance meant nothing compared to substance. At Princeton in the late 1940s, Volcker studied economics under Friedrich Lutz, a German economist who had fled Nazi Germany. Lutz taught him something crucial: that inflation destroys social trust. Weimar Germany's hyperinflation hadn't just wrecked the economy. It had shattered people's faith in government, creating the chaos that allowed Hitler's rise. This wasn't abstract theory. This was history with consequences. Volcker graduated summa cum laude in 1949, then pursued graduate studies at Harvard and the London School of Economics. But his real education came from watching the Federal Reserve struggle with its first major post-war crisis. In 1951, the Fed won independence from the Treasury Department in what became known as the Treasury-Fed Accord. For years, the Fed had been forced to keep interest rates low to help finance World War II debt. The accord freed the Fed to fight inflation independently. Young Volcker, just starting his career, saw this as proof that central banking required insulation from political pressure. Here's the thing: this lesson, that central banks must resist political demands, became Volcker's core conviction. It wasn't just economic theory, it was institutional survival. His first job was at the Federal Reserve Bank of New York in 1952. He was tall, gangly, brilliant with numbers, and completely uninterested in office politics. While colleagues networked and positioned themselves for promotions, Volcker buried himself in research papers about monetary policy. He wanted to understand the machinery of money, how currency flows, how banks create credit, how interest rates ripple through the economy. By 1957, he'd moved to Chase Manhattan Bank, where he spent 5 years in the private sector. This experience proved crucial. Volcker saw how traders thought, how markets moved, how quickly confidence could evaporate. He learned that monetary policy wasn't just about economic models, it was about psychology. If traders believed the Fed would allow inflation, they would act in ways that guaranteed inflation. If they believed the Fed would hold firm, they would adjust accordingly. What's interesting is that Volcker never became wealthy during his banking years. He earned a good salary, but didn't chase bonuses or stock options. In an era when Wall Street traders were becoming millionaires, Volcker remained decidedly middle class. His suit stayed rumpled, his cigars stayed modest. In 1962, the Kennedy administration recruited him back to the Treasury Department as Director of Financial Analysis. He was 35 years old, already recognized as someone who understood the plumbing of international finance better than almost anyone in government. The 1960s tested American monetary policy severely. President Lyndon Johnson wanted to finance both the Vietnam War and his Great Society programs without raising taxes. The Federal Reserve, led by Chairman William McChesney Martin, tried to maintain price stability while supporting presidential priorities. It was an impossible balance. Volcker watched inflation tick upward, slowly at first, barely noticeable, just 2 to 3% annually. But he saw the pattern forming: deficit spending, accommodative monetary policy, rising expectations that inflation would continue. The exact conditions that Friedrich Lutz had warned about at Princeton. By 1969, Volcker had become Undersecretary of the Treasury for International Monetary Affairs under President Nixon. He now sat at the center of global finance, and what he saw alarmed him deeply. The Bretton Woods system, the framework that had governed international monetary relations since 1944, was collapsing. Under Bretton Woods, the dollar was convertible to gold at $35 per ounce, and other currencies pegged themselves to the dollar. This arrangement had created post-war stability, but it required the United States to maintain confidence in the dollar's value. By 1971, that confidence was evaporating. Foreign governments, watching American inflation accelerate, began demanding gold in exchange for their dollar reserves. The U.S. gold supply drained away. Something had to give. On August 15, 1971, Volcker was in the room when Nixon made the decision that changed global finance forever. The United States would suspend gold convertibility. The dollar would float freely. The Bretton Woods system was finished. Volcker later called this the single most important decision in international monetary affairs in his lifetime. And here's what haunted him. Once the dollar's link to gold was severed, what would discipline American monetary policy? What would prevent politicians from inflating away their debts? The answer, theoretically, was Federal Reserve independence and wise policymaking. But theory and practice diverged sharply during the 1970s. Look at what happened. Inflation, which had been 4.4% in 1971, reached 11% by 1974. The Fed would tighten policy slightly, then retreat when recession threatened. This stop-start pattern failed to break inflation expectations. Workers and businesses learned to anticipate higher prices and adjusted their behavior accordingly. A wage price spiral took hold. Volcker spent the mid-1970s as president of the Federal Reserve Bank of New York, watching the Fed's credibility erode. He gave speeches warning about inflation's danger, but few listened. The prevailing economic theory, the Phillips curve, suggested that policymakers could choose between unemployment and inflation. A little more inflation could buy lower unemployment, economists argued. Volcker didn't believe it. His skepticism proved correct. By the late 1970s, America faced stagflation, high inflation and high unemployment simultaneously. The Phillips curve had broken down. The old economic certainties no longer held. But what really scared Volcker wasn't the economic data. It was the psychology he observed. Americans had stopped believing that stable prices were possible. They built inflation into every decision. Unions demanded double-digit raises. Businesses raised prices preemptively. Savers fled to gold and real estate, assuming paper currency would lose value. This inflation psychology, once established, couldn't be broken with gentle rate adjustments. It required shock therapy, a demonstration so dramatic that people would fundamentally revise their expectations. By 1979, Volcker was ready to provide that shock. But first, he needed the power to act. He needed to become Federal Reserve Chairman with all the institutional authority that office provided. President Jimmy Carter, desperate to control inflation that threatened his re-election, offered Volcker the job. Carter knew Volcker was a hawk on inflation. What Carter didn't fully grasp was just how far Volcker was willing to go. The transformation from talented economist to institutional power player happened during Volcker's years managing international monetary affairs for the Nixon administration. When Volcker joined the Treasury Department in 1969 as Undersecretary for International Monetary Affairs, the global financial system was showing cracks that would soon become chasms. His job was to defend the Bretton Woods system while everyone could see it was dying. The mathematics were brutal. The United States was running persistent balance of payments deficits, meaning more dollars flowed out of the country than flowed in. Under Bretton Woods rules, foreign central banks could exchange those excess dollars for gold at $35 per ounce. America's gold reserves were draining away at an alarming rate, from over 20,000 tons after World War II to under 9,000 tons by 1971. Germany, France, and Japan accumulated massive dollar holdings and periodically exchanged them for gold, testing American resolve. The system depended on foreign governments trusting the dollar's value. But Vietnam War spending and Great Society programs had flooded the world with dollars, eroding that trust. Volcker spent 1970 and 1971 in constant crisis management. He negotiated with German officials who wanted the Deutsche Mark to appreciate. He argued with French authorities who viewed American deficits as exploitation. He coordinated with the International Monetary Fund to defend a system everyone knew was unsustainable. What made Volcker different from other Treasury officials was his brutal honesty about the situation. While politicians made public statements defending the dollar, Volcker privately told Nixon's advisers the truth. The United States faced a fundamental choice between domestic inflation and international monetary stability. They couldn't have both. The decisive moment came in August 1971, when Nixon convened top advisers at Camp David for what became known as the weekend that changed the world. Volcker presented three options, each terrible in its own way. Option 1. Continue defending the gold price, which would require severe domestic austerity, raising taxes, cutting spending, accepting recession to restore confidence in the dollar. Politically impossible in an election cycle. Option 2. Devalue the dollar against gold, admitting that $35 per ounce was no longer sustainable. This would preserve the Bretton Woods framework, but humiliate the United States globally. Option 3. Close the gold window entirely, suspending convertibility, and letting the dollar float. This would end Bretton Woods, but give the United States monetary independence. Nixon chose Option 3. On Sunday evening, August 15, 1971, he announced on national television that the United States would no longer convert dollars to gold. Volcker, who had argued for a more diplomatic approach, watched his preferred strategy get rejected. Here's what's interesting. Volcker later admitted he was wrong. Nixon's blunt unilateral action, though diplomatically brutal, forced other countries to accept a new reality faster than gradual negotiation would have. Sometimes shock treatment works better than gentle persuasion, a lesson Volcker would apply later as Fed chairman. The immediate aftermath was chaos. Foreign exchange markets closed for days as governments scrambled to figure out what to do. Currency values swung wildly. International trade faced paralysis without stable exchange rates. But Volcker got to work building a new system. Over the next 18 months, he negotiated the Smithsonian Agreement, which temporarily stabilized exchange rates, then helped design the floating rate system that eventually emerged. This work taught him something crucial about international finance. Credibility matters more than promises. You see, under the old system, the dollar's credibility came from gold convertibility, a tangible physical anchor. Under the new system, credibility would have to come from Federal Reserve policy discipline. If the Fed allowed high inflation, the dollar would weaken against other currencies. If the Fed maintained price stability, the dollar would strengthen. There was no gold to hide behind anymore. This realization haunted Volcker throughout the 1970s. The Fed, he believed, hadn't adjusted to the new responsibility. Fed Chairman Arthur Burns, appointed by Nixon in 1970, accommodated the administration's desire for low interest rates before the 1972 election. Burns talked about fighting inflation, but acted tentatively, always pulling back when economic pain materialized. By 1974, inflation had reached 11%. Burns finally tightened monetary policy aggressively, triggering a severe recession in 1974-75. Unemployment jumped to 9%, but Burns eased too quickly before inflation expectations were fully broken. Inflation would fall temporarily, then roar back. Volcker watched this pattern repeat itself. Tighten, recession, ease, inflation returns. Each cycle eroded Fed credibility further. Markets learned that the Fed would always blink first when economic pain got severe. In 1975, Volcker left the Treasury to become president of the Federal Reserve Bank of New York. This position put him inside the Federal Reserve System, but outside the Board of Governors in Washington. He could observe the Fed's mistakes without being directly responsible for them. The New York Fed presidency was technically less powerful than a board governorship, but in practice it carried enormous influence. The New York Fed implements monetary policy through buying and selling securities. The president of the New York Fed permanently votes on the Federal Open Market Committee, which sets interest rates. And New York serves as the Fed's eyes and ears on Wall Street. Volcker used this position to build his reputation as an inflation hawk. He gave speeches warning that inflation was becoming embedded in American psychology. He argued that gradualism wouldn't work, that breaking inflation would require sustained commitment to tight money even through recession. Think about what he was arguing, that the Federal Reserve should deliberately cause economic pain to achieve price stability. This wasn't popular economics in the 1970s. The dominant view was that a little inflation was acceptable, even beneficial, if it meant lower unemployment, but Volcker had studied the data and saw something others missed. The relationship between unemployment and inflation was breaking down. You could have both high unemployment and high inflation, stagflation. The old trade-off had disappeared. By 1979, the situation had deteriorated dramatically. The Iranian Revolution disrupted oil supplies, sending gasoline prices soaring. But this was just a trigger. The real problem was that inflation expectations had become completely unanchored. Workers demanded double-digit wage increases, assuming prices would rise 10% to 15% annually. Businesses raised prices preemptively. Cost of living adjustments were built into union contracts. The whole economy operated on the assumption that inflation would continue indefinitely. Gold prices reflected this loss of confidence. Gold had traded around $200 per ounce through the mid-1970s. By early 1979, it had crossed $300. Investors were fleeing paper currency for hard assets, betting that the dollar would keep losing value. President Carter faced a dilemma. Inflation was destroying his presidency. His approval ratings had collapsed. The 1980 election loomed. He needed someone who could restore confidence in the dollar, but he also needed someone who wouldn't deliberately cause a recession right before voters went to the polls. Carter's advisors presented him with several candidates for Fed chairman to replace the outgoing G. William Miller. Some were political loyalists who would coordinate with the administration. Some were academic economists with impressive credentials. And then there was Volcker. Brilliant, experienced, completely independent, and known for putting price stability above political considerations. Carter faced pressure from multiple directions. His economic advisors warned that Volcker would be too aggressive. Liberal senators wanted someone more concerned with employment than inflation. Business leaders demanded credibility restoration. Foreign governments watched to see whether America was still serious about defending the dollar's value. In July 1979, Carter made his choice. Paul Volcker would become Federal Reserve Chairman. The decision shocked political insiders. Carter had essentially appointed someone who might wreck the economy before the election. But Carter understood something crucial. Without addressing inflation, he had no chance at re-election anyway. Better to try shock therapy than continue the gradual decline. Volcker accepted the appointment with clear conditions. He wanted full independence to set monetary policy without political interference. Carter agreed, though neither man fully appreciated what this would mean in practice. Because the strategy forming in Volcker's mind wasn't just about raising interest rates a few percentage points. It was about fundamentally reshaping how Americans thought about inflation, how markets thought about the Fed, and how the global economy thought about the dollar. The weapons were simple: interest rates and money supply targets. But the strategy was revolutionary, hit so hard, so fast, that expectations would shatter rather than gradually adjust. Within 3 months of taking office, Volcker would launch the most dramatic monetary policy experiment in modern American history, and the human cost would be staggering. By the summer of 1979, inflation had stopped being an economic problem and had become a cultural crisis. The Consumer Price Index showed inflation running at 13.5%, but that number barely captured the psychological breakdown occurring across America. Housewives walked into grocery stores and found prices had increased since the previous week. Homebuyers discovered that the house they'd been saving for had jumped $10,000 in price during negotiations. Retirement savings were evaporating in real terms, even as nominal account balances rose. Volcker took office on August 6, 1979, and immediately confronted a situation that had no historical parallel in peacetime America. This wasn't the hyperinflation of Weimar Germany. Prices weren't doubling monthly, but it was something almost worse: a sustained, accelerating inflation that had convinced Americans stable prices were impossible. The numbers tell only part of the story. Consumer Price Index, 13.5% year over year. Producer prices rising even faster at 15%. Oil prices jumped from $15 per barrel to nearly $40 in less than a year. Gold crossed $400 per ounce and climbing. The prime lending rate, already at 11.5% when Volcker took over, and businesses still demanded more credit because they expected inventory values to rise. But the real crisis was psychological. Inflation expectations, as measured by surveys, showed Americans anticipated 10% inflation indefinitely into the future. This expectation was self-fulfilling. If you believe prices will rise 10%, you demand a 10% raise. Your employer, expecting costs to rise 10%, raises prices 10%. The next worker sees prices up 10% and demands an even bigger raise. The spiral feeds itself. Volcker understood something that conventional economists missed. You can't fight expectations with economic models. You can't reason with a psychological crisis. You need to break it with action dramatic enough to shatter the assumption. His first Federal Open Market Committee meeting as chairman came in August 1979. The committee debates interest rate policy at these meetings, with the chairman wielding enormous influence over the decision. Previous Chairman Miller had favored cautious, incremental moves, raising rates a quarter percentage point at a time, always ready to retreat if the economy showed weakness. Volcker proposed something different: a full percentage point increase in the discount rate, the rate at which the Fed lends to banks. Committee members gasped. Such an aggressive move was unprecedented in peacetime. But Volcker argued that credibility required shock, not gradualism. The committee supported him, though several members expressed deep reservations. Wall Street reacted with surprise but also relief. Finally, a Fed chairman who seemed serious about fighting inflation. The dollar strengthened slightly against foreign currencies. Gold prices dipped. But within weeks, the effect wore off. Inflation continued accelerating. The Iranian hostage crisis, which began in November 1979, sent oil prices even higher. Inflation hit 14%. The interest rate increase hadn't been enough. What's interesting is that Volcker had anticipated this. He knew one rate increase wouldn't break expectations that had built over a decade. He needed a strategy that would sustain high rates long enough to cause real economic pain. Pain severe enough that workers would stop demanding double-digit raises and businesses would stop raising prices automatically. Traditional monetary policy worked through interest rates. The Fed would announce a target rate, then buy or sell securities to achieve it. This approach was transparent and predictable, but it had a fatal flaw. Everyone knew what the Fed was targeting, so they could game the system. If the Fed targeted 12% rates but inflation kept rising, markets would assume the Fed would eventually back down. Volcker decided to abandon the traditional approach entirely. Instead of targeting interest rates, he would target the money supply, the total amount of dollars in circulation. The Fed would limit how much the money supply could grow, regardless of what happened to interest rates. If banks and businesses demanded more money to fuel inflation, interest rates would rise automatically until demand fell. This strategy, called monetarism, had theoretical support from economist Milton Friedman and his followers, but it had never been tried by a major central bank during a crisis. Nobody knew whether it would work or whether the side effects would prove catastrophic. On October 6, 1979, Volcker called an extraordinary Saturday press conference to announce the new policy. The symbolism was deliberate. Weekend announcements signaled emergency action. Financial reporters crammed into the Fed's boardroom, sensing something major was coming. Volcker, standing before microphones with his characteristic cigar, explained the shift to money supply targeting in his flat technical voice. He didn't offer soaring rhetoric about saving the economy. He didn't promise easy solutions. He simply stated that the Federal Reserve would control money growth and let interest rates go wherever necessary to achieve that control. The immediate reaction mixed confusion with alarm. Money supply targeting sounded technical, abstract. What did it mean in practice? Volcker explained, the Fed would allow interest rates to fluctuate in a wider range than before. They might rise sharply. They might be volatile. But they would stay high until inflation expectations broke. Financial markets grasped the implications faster than the general public. This wasn't a modest policy adjustment. This was the Fed announcing it would engineer a recession severe enough to kill inflation, regardless of political consequences. The stock market plunged Monday morning. Bond yields spiked. The prime rate jumped immediately. Within weeks, mortgage rates crossed 15%. Car loans became unaffordable for most buyers. Business borrowing slowed as credit costs soared. But here's what made Volcker's strategy truly revolutionary. He wasn't trying to fine-tune the economy or balance competing objectives. He had a single goal, breaking inflation expectations, and was willing to sacrifice everything else to achieve it. Look at the political context. President Carter faced re-election in 1980. The last thing he needed was a Fed-induced recession. Carter's advisors begged Volcker to reconsider. Liberal economists accused him of causing unnecessary suffering. Conservative economists worried he'd gone too far too fast. Volcker ignored them all. He'd spent a decade watching the Fed lose credibility through timid half-measures. This time would be different. This time the Fed would prove it meant what it said. The human impact arrived quickly. Construction ground to a halt as mortgage rates made new homes unaffordable. Auto sales collapsed as car loans became prohibitively expensive. Small businesses couldn't get credit or couldn't afford the rates banks charged. Unemployment began rising, slowly at first, then accelerating. By December 1979, just 2 months after the policy shift, the economy was clearly weakening. Manufacturing output fell, retail sales declined, business confidence surveys showed pessimism spreading. Wall Street analysts predicted recession. Traditional Fed policy would have called for easing at this point, lowering rates to prevent recession from deepening. But Volcker held firm. Inflation was still running at 13%. Expectations hadn't budged. Workers still demanded double-digit raises. Until those expectations broke, the Fed wouldn't ease. The most controversial aspect of Volcker's approach was his willingness to accept recession as the price of disinflation. Previous Fed chairs had viewed recession as a policy failure to be avoided. Volcker viewed recession as a necessary tool for breaking inflation psychology. Think about the moral calculus here. Volcker was deliberately engineering unemployment to achieve price stability. People would lose jobs, homes, businesses, families would struggle, communities would suffer, and Volcker knew it would happen before he started. His defenders argued that inflation itself caused suffering, eroding savings, punishing the poor who couldn't protect themselves with inflation hedges, destroying social trust. Short-term recession, they claimed, was better than permanent inflation. His critics called it economic violence against working people. The debate intensified as 1979 ended and 1980 began. Carter imposed credit controls in March 1980, trying to slow inflation without relying solely on Fed policy. The controls backfired spectacularly, causing credit markets to freeze and recession to deepen. Carter lifted the controls within months, but damage was done. By mid-1980, unemployment had risen to 7.5%. The economy was officially in recession. Carter's poll numbers cratered. And inflation? Still running above 12%. Volcker faced his first major test. Would he ease policy to help the economy recover, Or would he stay the course despite recession and political pressure? He chose to stay the course, but with a tactical adjustment. When credit controls were lifted and credit demand surged, Volcker allowed the money supply to grow temporarily, letting interest rates fall slightly. This wasn't a reversal. It was a recognition that crushing credit demand too suddenly could trigger financial crisis rather than gradual disinflation. The brief easing brought relief. The economy began recovering in summer 1980. Unemployment fell slightly. Businesses regained confidence. Carter's advisors hoped the worst was over. They were wrong. Volcker's strategy required sustained commitment, not one quick shock. Inflation had dipped modestly but hadn't died. Expectations remained elevated. The job was far from finished. As 1980 ended and Reagan won the presidency, Volcker prepared for round two of his anti-inflation campaign. This time would be even more severe. This time, he would push rates higher and hold them longer. And this time, the economic destruction would be total. Because Volcker had learned something from the 1980 experience, timid tightening followed by premature easing just extended the agony without solving the problem. Better to hit harder the second time and finish the job completely. The second shock would make the first look gentle by comparison. December 1980 marked the beginning of the most aggressive anti-inflation campaign in modern central banking history. Inflation had fallen from 14% to around 12% during the brief 1980 recession, but Volcker could see it stabilizing at an unacceptably high level. Workers still expected double-digit price increases. Cost of living adjustments remained standard in union contracts. Businesses continued raising prices preemptively. The psychology hadn't broken. It had merely paused. So Volcker engineered a second shock, this time more severe and sustained than the first. The Federal Open Market Committee met throughout late 1980 and early 1981, steadily tightening money supply targets. The discount rate rose to 13%. The federal funds rate, the rate banks charge each other for overnight loans, jumped to 15%, then 17%, then 19%. By May 1981, it had reached 20%. These numbers sound abstract until you translate them into real-world impact. A mortgage at 18% interest meant that on a $100,000 loan, buyers would pay $1,500 per month just in interest. Before principal repayment, the monthly payment on that mortgage was higher than the median monthly income for American families. Housing construction didn't just slow, it collapsed. Housing starts fell from 1.7 million units annually in 1978 to under 1 million by 1981. Construction workers, who had earned middle-class wages during the 1970s building boom, found themselves unemployed by the hundreds of thousands. The auto industry faced similar devastation. Car loans at 20% interest priced most buyers out of the market. Chrysler nearly went bankrupt, saved only by federal loan guarantees. Ford and General Motors slashed production and closed factories. The United Auto Workers, one of America's most powerful unions, watched helplessly as their members' jobs disappeared. Small businesses that depended on credit lines to manage cash flow found themselves crushed between rising interest costs and falling sales. The Small Business Administration reported that business failures in 1981 ran 30% higher than the previous year. Main Street retailers, manufacturers, and service businesses closed by the thousands. But Volcker refused to ease policy. He made a commitment to break inflation completely, and he would keep that commitment regardless of the economic carnage. What made his strategy particularly brutal was the volatility he introduced into interest rates. Under the money supply targeting regime, rates could swing by several percentage points in a single month. This volatility made planning impossible. Businesses couldn't forecast their borrowing costs. Home buyers couldn't predict whether they'd qualify for mortgages. The uncertainty itself dampened economic activity. The political pressure became extraordinary. President Reagan had taken office in January 1981, promising to restore American prosperity. His supply-side economic advisors argued for tax cuts and deregulation, not monetary-induced recession. Reagan's chief of staff, James Baker, urged the president to pressure Volcker into easing. But Reagan made a strategic decision that would define both his presidency and Volcker's success. He publicly supported the Fed's independence even while privately questioning Volcker's tactics. Reagan understood that undermining the Fed would destroy the credibility Volcker was trying to build. Better to endure political pain than sabotage the anti-inflation campaign. This political cover proved crucial. With the president refusing to attack the Fed publicly, other critics lacked a clear leader around whom to organize opposition. Volcker could continue tightening policy without facing the full force of political resistance. Still, the protests came. Farmers, devastated by high interest rates on equipment loans and falling commodity prices, drove tractors to Washington in protest. The American agricultural movement organized demonstrations outside the Federal Reserve Building. Farmers carried signs reading, "Dump Volcker," and burned the Fed chairman in effigy. The agricultural crisis was particularly severe because farmers had borrowed heavily during the 1970s to buy land when prices were rising. With interest rates now at 20% and crop prices falling due to recession, thousands of family farms faced foreclosure. The farm credit system, which provided agricultural loans, teetered on the edge of collapse. Construction unions, watching their members lose jobs, called Volcker the most dangerous man in America. The AFL-CIO passed resolutions demanding his resignation. Democratic politicians, seeking to distance themselves from Carter's appointment of Volcker, denounced the Fed's policies as warfare against working people. But here's what's remarkable. Volcker didn't hide from the criticism. He gave speeches explaining his strategy, appeared before congressional committees to defend the Fed's policies, and engaged directly with critics. He didn't claim the pain was necessary, but unintended. He acknowledged it was deliberate. In one particularly revealing moment, Volcker told a congressional committee that he understood the suffering his policies caused, but that allowing inflation to continue would cause even greater long-term damage. He said the Fed had to stay the course even when the course meant recession. This honesty was unusual for central bankers who typically hide behind technical jargon and refuse to acknowledge policy trade-offs. Volcker's directness, while politically costly, actually enhanced his credibility with financial markets. Traders believed him when he said rates would stay high because he had proven willing to accept enormous criticism rather than back down. By mid-1981, the economy was sliding into deep recession. Unemployment hit 8%, then 9%, then kept climbing. Manufacturing capacity utilization, the percentage of factory capacity actually being used, fell to levels not seen since the 1930s. Corporate profits collapsed. The stock market languished. And yet inflation remained stubbornly high. The Consumer Price Index showed inflation falling from 12% to 10% to 8.5%, but that was still far above Volcker's target of 3% to 4%. Wage growth remained at 8 to 9% annually. The expectation that inflation would stay elevated persisted despite mounting economic pain. Volcker faced a credibility test. Would he keep rates high long enough to truly break expectations? Or would he ease prematurely as previous Fed chairs had done? He decided to go even further. In the fall of 1981, with unemployment approaching 9% and recession deepening, Volcker tightened policy again. The federal funds rate briefly touched 21.5%, the highest level in Federal Reserve history before or since. This decision defied conventional economic wisdom. Standard policy says you ease during recessions, not tighten. But Volcker understood that credibility required proving the Fed would do whatever it took to kill inflation. Half measures would just extend the crisis. The human cost mounted daily. By late 1981, unemployment exceeded 10% for the first time since the Depression. Major industrial cities, Detroit, Pittsburgh, Cleveland, saw unemployment rates above 15%. Black unemployment reached 20%. Youth unemployment approached 25%. Food banks reported surging demand. Homeless shelters filled beyond capacity. Social services were overwhelmed by families who'd never needed assistance before but now couldn't find work. Look at the specific industries. Steel production fell by 40% as manufacturers cut output and closed mills. The trucking industry contracted sharply as shipping volumes collapsed. Retail chains like Montgomery Ward closed hundreds of stores. The entire industrial Midwest faced economic devastation that would persist for decades. And the geographic concentration of pain made it politically explosive. Volcker's policies didn't affect all Americans equally. The financial sector, while suffering reduced profits, largely survived intact. Wealthy individuals with diversified investments weathered the storm, but industrial workers, farmers, and small business owners bore disproportionate costs. Critics accused Volcker of class warfare, of sacrificing blue-collar workers to protect bondholders and creditors. The accusation wasn't entirely wrong. Inflation helps debtors and hurts creditors by eroding the real value of debts. Disinflation does the opposite. It helps creditors at debtors' expense. Volcker's response was that inflation hurt poor and working-class people, most because they lacked the financial sophistication to protect themselves with inflation hedges. Wealthy people bought real estate, commodities, foreign currencies. Poor people held cash and savings accounts that lost purchasing power daily. In this view, fighting inflation was protecting the vulnerable. But this argument rang hollow to workers watching their factories close, while Wall Street bankers kept their jobs. The recession was destroying their lives regardless of whatever long-term benefits Volcker promised. By early 1982, the political situation had become untenable. Unemployment hit 10.8%, the highest rate since the Great Depression. Reagan's approval rating collapsed below 40%. The 1982 midterm elections loomed, with Republicans facing potential electoral disaster. Reagan's advisers intensified pressure on Volcker to ease. Treasury Secretary Donald Regan, former head of Merrill Lynch, argued that the medicine had become worse than the disease. Republican senators facing tough re-election fights begged the administration to do something about interest rates. But Reagan held firm in his public support for Fed independence. He met with Volcker privately and expressed concern, but he never publicly attacked the Fed or demanded policy changes. This restraint was remarkable given the political pressure Reagan faced. Meanwhile, Volcker confronted a different crisis. Several major banks were approaching insolvency due to bad loans made during the inflation years. Continental Illinois, one of the largest banks in America, faced a crisis of confidence as depositors withdrew funds. The Latin American debt crisis was emerging as countries that had borrowed heavily at floating interest rates found themselves unable to service debts at the new high rates. Volcker had to navigate between two competing risks. Easing too soon would abort the anti-inflation campaign, but tightening too much could trigger financial crises that would force emergency easing anyway. He chose to hold rates at restrictive levels while providing targeted support to prevent financial collapse. The Fed extended credit to troubled banks. It coordinated with foreign central banks to manage the debt crisis. It allowed the money supply to grow slightly faster than targets to prevent complete credit freeze. This tactical flexibility, while maintaining strategic commitment, showed Volcker's sophistication. He wasn't rigidly following monetarist doctrine. He was using monetary targets as a tool to build credibility while remaining pragmatic enough to prevent catastrophic financial failure. By mid-1982, something remarkable began happening. Survey data showed Americans revising downward their expected future inflation. Wage demands moderated, businesses stopped automatic price increases. Gold prices fell from their 1980 peak of $850 to under $400. The psychology was shifting. After 3 years of sustained high interest rates and deep recession, people were starting to believe that the Fed really would keep rates high until inflation died. This belief change was exactly what Volcker had been engineering. And once expectations began shifting, actual inflation followed quickly. The CPI fell from 8.5% to 6% to 4% over the course of 1982. Wage growth slowed from 9% to 6% to 4%. The spiral was reversing. Volcker had achieved what he'd set out to do. He'd broken the inflation psychology that had gripped America for over a decade. The cost had been the worst recession in 50 years, but the prize was credibility that would reshape central banking globally. The winter of 1982 marked the darkest moment of Volcker's experiment, when even his supporters questioned whether he'd pushed too far. Unemployment hit 10.8% in December 1982, translating to 12 million Americans without jobs. But national statistics couldn't capture the concentrated devastation in industrial regions. Detroit's unemployment exceeded 17%. Youngstown, Ohio, where steel mills had been the economic backbone, saw unemployment above 20%. Entire cities faced economic extinction. The human stories behind these numbers were devastating. Factory workers, who'd spent entire careers at single companies found themselves unemployed in their 50s with obsolete skills. The manufacturing jobs that had provided middle-class wages for workers without college degrees were disappearing permanently. Many would never return to similar employment. Consider what was happening in specific sectors. The steel industry had employed over 400,000 workers at its peak in the 1970s. By 1982, employment had fallen below 200,000 as mills closed across Pennsylvania, Ohio, and Indiana. These weren't temporary layoffs. They were permanent shutdowns, as American steel became uncompetitive against foreign producers who'd modernized while American companies delayed investment during the inflationary 1970s. The auto industry faced similar structural collapse. Chrysler's near bankruptcy in 1980 had been just the beginning. Ford lost $3.3 billion in 1980 to 1982, the largest corporate loss in American history at the time. General Motors, which had never posted an annual loss, lost $763 million in 1980. These companies didn't just cut production, they closed entire assembly plants that would never reopen. What made the crisis particularly cruel was that Volcker's high interest rates were accelerating the destruction of industries already weakened by foreign competition and technological change. The rates didn't just cause cyclical recession, they forced permanent structural adjustment. Small businesses faced a different, but equally devastating crisis. The combination of high borrowing costs and collapsed consumer demand created impossible conditions. A hardware store owner who'd operated successfully for 20 years found that the interest on his inventory credit line now exceeded his profit margin. A restaurant owner watched customers disappear as middle-class families cut discretionary spending. An independent trucking company couldn't afford the interest on loans for new trucks while shipping volumes fell. The Small Business Administration reported that business bankruptcy filings in 1982 reached levels not seen since the Depression. These weren't just statistics. They were generational family businesses destroyed, life savings wiped out, entrepreneurial dreams crushed. The farming crisis deserved special attention because it would reverberate for the rest of the decade. Farmers had borrowed heavily in the 1970s, when inflation made farmland a speculative investment and commodity prices seemed destined to rise forever. Land prices in Iowa had tripled between 1972 and 1981 as farmers bid against each other using borrowed money. Then Volcker's policies triggered a perfect storm. Interest rates on farm loans jumped to 20%, commodity prices collapsed due to recession reducing demand, and land prices crashed as speculative buyers disappeared. Farmers found themselves owing more than their land was worth, with interest payments exceeding their annual income. The farm foreclosure wave destroyed rural communities across the Midwest. Iowa, Nebraska, Kansas, states where family farming had been a way of life for generations, saw thousands of foreclosures. Farm auctions, where neighbors gathered to watch families lose everything, became traumatic community events. Suicide rates among farmers spiked. The farm credit system, which had financed agricultural lending for decades, teetered on the edge of insolvency as its loan portfolio imploded. The federal land banks, farm credit banks, and production credit associations, institutions that had seemed rock solid, faced potential collapse. But here's what made Volcker's position so difficult. He couldn't ease monetary policy to help farmers without abandoning the anti-inflation fight and potentially triggering a worse crisis later. The Fed wasn't heartless. It understood the suffering, but Volcker believed that giving in to political pressure would destroy the credibility needed to finish the job. The banking system faced mounting stress. Continental Illinois, the seventh largest bank in America, had made aggressive loans during the 1970s boom. Now those loans were defaulting at accelerating rates. Energy loans to oil companies that had borrowed assuming $40 per barrel oil now faced reality as prices fell. Real estate loans backed by properties worth half their 1980 values went bad. Latin American sovereign debt, which seemed safe when extended, became dubious as developing countries struggled to service loans at 20% interest. Continental Illinois faced a slow-motion bank run throughout 1982 and early 1983. Large depositors, those with balances exceeding the FDIC insurance limit of $100,000, withdrew funds, fearing the bank would fail. The Fed had to provide emergency liquidity to prevent collapse. This banking stress complicated Volcker's strategy. If major banks started failing, he'd have to ease monetary policy dramatically to prevent financial system collapse. The whole anti-inflation campaign could abort before expectations fully broke. The political pressure reached a crescendo in mid-1982. Unemployment above 10% combined with midterm elections created an explosive situation. House Democrats, sensing opportunity, blamed the recession entirely on Volcker's policies. They introduced resolutions calling for his resignation. Congressional hearings became platforms for attacking the Fed. The AFL-CIO launched a campaign to pressure Reagan into replacing Volcker. Union leaders argued that the Fed was deliberately creating unemployment to weaken labor's bargaining power. This wasn't entirely paranoid. Some Fed officials had explicitly stated that reducing wage growth required raising unemployment. Farmers organized protests that combined economic desperation with raw anger. The American agriculture movement coordinated tractor convoys to Washington. Farmers surrounded the Federal Reserve building, demanding Volcker meet with them. When he did, the meetings were tense and sometimes hostile. Farmers didn't want explanations about inflation expectations. They wanted to save their farms. Reagan faced an impossible position. The economy was collapsing. His approval rating had fallen to 35%, and Republicans faced potential disaster in the 1982 midterms. His advisors were split. Supply-siders blamed Volcker's tight money for sabotaging Reagan's tax cuts, while pragmatists argued that easing would trigger runaway inflation. But Reagan made a crucial decision. He would continue supporting Fed independence publicly, while privately making clear to Volcker that the political situation was becoming untenable. This pressure wasn't a demand to ease. It was a warning that even presidential support had limits. Volcker got the message. By mid-1982, he began signaling that while rates would remain restrictive, the Fed was monitoring economic conditions closely. This subtle shift in tone, without any immediate policy change, helped calm markets slightly. What's interesting is what was happening beneath the surface. Inflation was dying faster than most people realized. The CPI showed inflation falling from 8.9% in January 1982 to 4.8% by December, a stunning decline. Producer prices were falling even faster, suggesting the pipeline of future inflation was emptying. More importantly, inflation expectations were collapsing. The University of Michigan's Consumer Survey showed expected inflation falling from 10% to 6% over the course of 1982. This expectation shift was exactly what Volcker needed. Once people stopped expecting inflation, they stopped acting in ways that caused inflation. Wage negotiations reflected the psychological change. Unions that had demanded 10 to 12% raises in 1980 were settling for 3 to 5% in 1982. Some contracts included actual wage freezes or concessions, unthinkable just 2 years earlier. The United Auto Workers, which had won 12% annual raises in the 1970s, accepted a wage freeze at Ford to help the company survive. The break in expectations meant Volcker had achieved his primary objective. The psychology that had sustained inflation for over a decade was shattered. Workers, businesses, and investors now believed the Fed would keep rates high indefinitely rather than tolerate inflation. This credibility breakthrough meant the worst was over, not economically, which would take years to recover, but strategically. Once expectations broke, Volcker could begin easing policy without triggering renewed inflation. In August 1982, with unemployment still above 10% but inflation clearly defeated, Volcker began the gradual process of lowering interest rates. The federal funds rate fell from 14% to 12% to 10% over several months. The discount rate followed downward. This easing wasn't a capitulation to political pressure. It was a strategic pivot made possible by success in breaking inflation expectations. Volcker had proven he would keep rates high as long as necessary. Now that expectations had shifted, he could allow the economy to recover without fear of reigniting inflation. The stock market understood the implication immediately. In August 1982, the Dow Jones Industrial Average began the longest bull market in American history, rising from 776 to over 11,000 by the late 1990s. Bond yields began a multi-decade decline as investors gained confidence in low inflation. But the real economy took far longer to recover. Unemployment remained above 10% through mid-1983. The industrial Midwest's manufacturing base had been permanently damaged. Small businesses that had failed didn't reopen just because rates fell. Farming communities devastated by foreclosures didn't recover their former prosperity. Look at the long-term impact, the recession of 981. 8-2 marked the beginning of manufacturing's decline. As the center of the American economy, the steel industry never recovered its former employment levels. Auto manufacturing increasingly moved to non-union southern states or overseas. The high-wage, low-skill manufacturing jobs that had built the middle class became scarce. Volcker's defenders argue these structural changes were inevitable. Globalization and technology would have transformed American manufacturing regardless of monetary policy. The high interest rates simply accelerated adjustments that were coming anyway. Critics argue that Volcker's shock therapy destroyed viable industries and communities unnecessarily. A more gradual approach to disinflation, they claim, might have preserved more manufacturing capacity while still achieving price stability. The debate continues among economists, but one thing is clear. The recession of 1981-82 represented a fundamental break in American economic history. The post-World War II era of rising industrial employment and automatically expanding middle-class prosperity ended. The new economy that emerged featured lower inflation, but also greater inequality, more precarious employment, and regional economic divergence. Volcker had won the war against inflation, but the victory came at a cost measured in closed factories, foreclosed farms, bankrupt businesses, and millions of disrupted lives. Whether that cost was necessary or excessive remains one of the most contentious questions in modern economic history. By 1983, Volcker faced a paradox. He'd won the war against inflation, but was losing the battle for his own political survival. Inflation had fallen to 3.8% by the end of 1982, the lowest rate in over a decade. Wage growth had moderated. Inflation expectations had collapsed. By every measurable standard, Volcker's strategy had succeeded. Yet the economic devastation he'd engineered made him one of the most hated public figures in America. President Reagan faced a decision in 1983 about whether to reappoint Volcker when his term as Fed chairman expired in August. The political calculation was complex. Reagan's economic advisors were split. Supply-siders like Jack Kemp and Arthur Laffer blamed Volcker for sabotaging Reagan's tax cuts with tight money. Pragmatists like James Baker and George Shultz recognized that replacing Volcker would spook financial markets. Reagan's own instincts leaned toward finding a replacement. He'd never been comfortable with Volcker's independence or his willingness to tolerate high unemployment. Treasury Secretary Donald Regan actively lobbied for choosing someone more responsive to administration priorities. But financial markets sent a clear message. Volcker's credibility was the foundation of the economic recovery beginning to take hold. When rumors circulated that Reagan might replace him, bond yields spiked and the dollar weakened. Wall Street made clear that Volcker's departure would be interpreted as abandoning the fight against inflation. Reagan, always politically astute, recognized he had no real choice. In June 1983, he announced he would reappoint Volcker to a second term. The announcement steadied markets and signaled continuity in monetary policy. But Volcker's victory came with a price. He now owed Reagan political loyalty at precisely the moment the administration wanted easier money to fuel the recovery heading into the 1984 election. The tension between Fed independence and political reality would define Volcker's second term. The economy's recovery through 1983. 84 vindicated Volcker's strategy in ways that silenced many critics. GDP growth surged to 7.2% in 1984, one of the strongest years in post-war history. Unemployment fell from 10.8% to 7.3%. The stock market soared. Reagan's Morning in America campaign message resonated because the economy was genuinely improving. But beneath the macro statistics, the structural damage from the recession persisted. Manufacturing employment, which had peaked at over 19 million in 1979, stabilized around 18 million and would never return to former levels. The industrial Midwest continued struggling even as the national economy boomed. Income inequality, which had been relatively stable through the 1970s, began widening as high-wage manufacturing jobs disappeared. Volcker himself seemed ambivalent about his legacy during this period. He gave speeches celebrating the return of price stability, but also acknowledged the costs his policies had imposed. In a 1983 speech, he said something remarkable. "We did what we had to do, but I take no pleasure in the suffering it caused." This honesty was unusual for a central banker, Most prefer to obscure policy trade-offs behind technical jargon. Volcker's willingness to acknowledge that he'd deliberately engineered recession enhanced his credibility, but also made him vulnerable to moral criticism. The Latin American debt crisis, which had been simmering since 1983, Mexico defaulted on its sovereign debt in August 1982, followed by Brazil and Argentina. These countries had borrowed heavily from American banks during the 1970s, when commodity prices were high and interest rates were low. Volcker's interest rate shock had made their debt service costs explode, while recession reduced their export revenues. The crisis threatened major American banks with insolvency. Citibank, Bank of America, Chase Manhattan, and others had enormous exposure to Latin American debt. If multiple countries defaulted, several of the largest banks in America could fail simultaneously, triggering a financial crisis that would dwarf the 1981-82 recession. Volcker spent much of 1983-84 coordinating an international response to the debt crisis. The Fed worked with the International Monetary Fund, Treasury Department, and foreign central banks to arrange emergency financing for debtor countries while restructuring their debts to prevent outright default. This crisis management showed a different side of Volcker, not the inflation hawk willing to tolerate recession, but the pragmatic crisis fighter willing to extend credit and coordinate bailouts to prevent systemic collapse. Critics accused him of inconsistency, tight money for Main Street, bailouts for Wall Street. Volcker defended the apparent contradiction by distinguishing between monetary policy and financial stability. Fighting inflation required tight money that caused economic pain. Preventing financial crisis required targeted intervention to stop contagion. The goals were different, so the tools were different, but the political optics were terrible. Farmers who'd lost their land due to high interest rates watched major banks get federal support. Small businesses that had gone bankrupt saw Citibank rescued from its bad loans to Latin America. The perception that Volcker protected financial institutions while sacrificing ordinary Americans fueled lasting resentment. The banking crisis also forced a policy contradiction that Volcker never fully resolved. He'd justified high interest rates as necessary to fight inflation expectations. But the Latin American debt crisis resulted directly from those high rates making existing debts unpayable. In effect, Volcker's monetary policy created the financial crisis that then required Fed intervention to resolve. This dynamic tight money causing distress, then Fed intervention to prevent collapse, would become a recurring pattern in American monetary policy. Critics call it the Greenspan put, or moral hazard, the idea that the Fed prevents financial losses for big players while allowing small players to suffer. But the pattern arguably began with Volcker's dual role as inflation fighter and crisis manager. By 1985, with inflation under control and the economy growing strongly, Volcker faced a new challenge: preventing the Reagan administration from pressuring the Fed into overly easy policy that might reignite inflation. Treasury Secretary James Baker, who replaced Donald Reagan in 1985, wanted lower interest rates to weaken the dollar and help American exporters. The dollar had surged during the early 1980s as high U.S. interest rates attracted foreign capital. This strong dollar made American exports expensive and contributed to widening trade deficits. Baker coordinated the Plaza Accord in September 1985, where major countries agreed to intervene in currency markets to weaken the dollar. He wanted the Fed to support this effort by cutting interest rates aggressively. Volcker resisted, arguing that monetary policy should focus on domestic price stability, not exchange rates. The tension between Baker and Volcker became public and personal. Baker would give speeches calling for lower rates. Volcker would respond with statements emphasizing continued vigilance against inflation. Financial journalists covered their conflict like a heavyweight fight. Reagan, entering his second term with high approval ratings, seemed more willing to challenge Volcker than during his first term. The president made public comments suggesting the Fed should be more supportive of economic growth. While carefully avoiding direct attacks on Volcker, Reagan created political space for others to pressure the Fed. The Federal Open Market Committee became increasingly divided during this period. Reagan had appointed several new Fed governors who favored easier policy. Volcker found himself fighting within the Fed as well as against external pressure. In 1986, Volcker faced his most serious internal rebellion. The Fed governors, led by Vice Chairman Preston Martin, voted to cut the discount rate despite Volcker's opposition. This unprecedented move, overruling the chairman on his signature policy tool, signaled that Volcker's control over Fed policy was weakening. Volcker considered resigning after this humiliation. The Fed chair's power depends partly on formal authority, but largely on respect and deference from other committee members. Once that deference erodes, the chairman becomes just another committee member. But Volcker decided to stay and fight. He recognized that his departure would be interpreted as capitulation to political pressure for easier money. Markets would assume the Fed was abandoning its commitment to price stability. The credibility he'd built through the early 1980s would evaporate. So he remained, even as his influence declined and his relationship with the Reagan administration deteriorated. Through 1986 and early 1987, Volcker managed to prevent dramatic policy easing, but he couldn't stop the gradual drift toward accommodation. The situation came to a head in June 1987, when Volcker's term was again expiring. Reagan, no longer dependent on Volcker's credibility to steady markets, decided to replace him. The administration offered Volcker reappointment if he'd commit to coordinating more closely with Treasury policy. Volcker refused. Reagan nominated Alan Greenspan, an economic advisor who shared Reagan's ideological orientation and would presumably be more cooperative with administration priorities. Greenspan's appointment marked the end of the Volcker era at the Fed. Volcker's departure occasioned retrospectives assessing his chairmanship. The consensus view, even among critics, was that he'd fundamentally transformed American monetary policy and restored Fed credibility. But the assessment of his methods remained contested. Supporters celebrated his willingness to make hard choices and absorb political criticism. Critics argued that his shock therapy had caused unnecessary suffering and that gradual disinflation could have achieved similar results with less pain. What both sides recognized was that Volcker had proven central bank independence could survive intense political pressure. He'd shown that an unelected official could pursue deeply unpopular policies and keep his job if he maintained credibility with financial markets, and delivered results. This lesson would reshape democratic capitalism globally. The Volcker precedent established that central banks insulated from political pressure could make time-inconsistent decisions, policies unpopular in the short run, but beneficial long-term, that elected politicians couldn't pursue. But it also raised profound questions about democracy and accountability. Is it healthy for unelected officials to engineer recessions that cost millions of jobs? Should monetary policy be isolated from democratic input? Where's the boundary between necessary independence and unaccountable power? These questions, which Volcker's chairmanship brought into focus, remain central to debates about central banking today. When Alan Greenspan took over the Federal Reserve in August 1987, he inherited an economy transformed by Volcker's 8-year war against inflation. Inflation was running at 3.6%, down from 13.5% when Volcker started. Inflation expectations, as measured by surveys and market indicators, had stabilized around 3 to 4% for the long term. Workers no longer automatically demanded double-digit raises. Businesses no longer raised prices preemptively. The psychology that had sustained inflation through the 1970s was dead. More importantly, the Federal Reserve had regained credibility. Financial markets believed the Fed would prevent inflation from accelerating again. This credibility was Volcker's lasting gift to his successors. They could conduct monetary policy without constantly fighting inflation expectations. The numbers tell the story of Volcker's achievement. When he took office in August 1979, the federal funds rate was 11%, inflation was 13.5%, and unemployment was 6%. When he left in August 1987, the federal funds rate was 6.5%, inflation was 3.6%, and unemployment was 6.2%. The economy had returned to roughly the same employment level, but with inflation reduced by 10 percentage points. The human cost of this achievement was measured in different numbers. During the 1981-82 recession, over 12 million Americans lost jobs. Approximately 400,000 businesses failed. Farm foreclosures exceeded 100,000. The unemployment rate had peaked at 10.8%, the highest since the Depression. Entire industries had been restructured. Manufacturing employment fell by over 1 million jobs during Volcker's chairmanship and would never recover. The industrial Midwest experienced permanent economic decline. Income inequality, which had been relatively stable through the 1970s, accelerated sharply during the 1980s. But Volcker's defenders argued that the alternative would have been worse. They pointed to countries that hadn't fought inflation aggressively: Argentina, Brazil, and experienced hyperinflation that destroyed their economies far more thoroughly than disinflation would have. The counterfactual is impossible to prove. We'll never know whether America would have slipped into hyperinflation if Volcker hadn't acted, or whether a more gradual approach could have achieved the same disinflation with less pain. What we can say with confidence is that Volcker's strategy worked by its own terms. He set out to break inflation expectations, and he succeeded. He wanted to restore Fed credibility, and he did. He aimed to make price stability the central bank's primary focus, and that became the new orthodoxy. The global influence of Volcker's approach was profound and immediate. Central banks worldwide studied the Volcker experiment and drew lessons that would reshape monetary policy internationally. The European Central Bank, established in 1998, was explicitly modeled on the Volcker Fed's commitment to price stability above all else. The ECB's mandate prioritizes low inflation over full employment, a direct legacy of Volcker's demonstration that central banks must resist political pressure for easy money. The Bank of England gained independence from the British Treasury in 1997, partly because Tony Blair's government wanted to import the credibility that independent inflation-fighting central banks had achieved. The Reserve Bank of New Zealand pioneered inflation targeting in 1989, formalizing the approach Volcker had implemented informally. Even developing countries embraced central bank independence and inflation fighting as orthodoxy. Brazil granted its central bank independence in 1994 after experiencing hyperinflation. Chile, South Korea, Mexico all restructured their central banks following the Volcker model during the 1990s. This global convergence on inflation targeting and central bank independence represented the internationalization of Volcker's philosophy. The idea that unelected technocrats should control monetary policy, insulated from political pressure, became the dominant global framework. But the Volcker legacy contained tensions that would emerge later. His success in breaking inflation created a generation of central bankers who viewed inflation as the primary threat and unemployment as secondary. This asymmetric focus, treating inflation as intolerable but unemployment as regrettable but acceptable, would shape monetary policy for decades. The 2008 financial crisis exposed this asymmetry. Central banks were slow to respond to rising unemployment because they'd been trained to fear inflation above all else. The European Central Bank raised interest rates in 2011, despite high unemployment, prioritizing inflation concerns. The Fed kept rates near zero for years after 2008, but faced internal resistance from inflation hawks channeling Volcker's spirit. Whether Volcker himself would have made the same choices is unknowable. He was fighting 1970s inflation, not 2008 deflation. But his intellectual legacy, the paramount importance of credibility and inflation control, influenced central bankers who applied his lessons to different circumstances. Volcker's post-Fed career burnished his reputation as a public servant, motivated by duty rather than personal gain. He earned substantial fees as a consultant, but lived modestly. He chaired the commission investigating the UN oil for food scandal, demonstrating his characteristic thoroughness and integrity. He advised President Obama during the 2008 financial crisis, though his recommendations were largely ignored. The Volcker Rule, included in the 2010 Dodd-Frank financial reform law, banned banks from making speculative investments with federally insured deposits. The rule bore Volcker's name because he championed it as necessary to prevent future financial crises. His advocacy showed he'd evolved from pure inflation fighting to broader concern about financial stability. In his later years, Volcker expressed some ambivalence about his legacy. He acknowledged the costs of disinflation, but maintained it was necessary. He worried that central banks had become too powerful and too isolated from democratic input. He questioned whether the financialization of the American economy that accelerated after inflation died had been entirely healthy. These late-career reflections showed intellectual humility unusual among successful policymakers. Volcker never claimed his approach was perfect or cost-free. He acknowledged trade-offs and expressed respect for critics who questioned his methods. When Volcker died in December 2019 at age 92, the obituaries were remarkably uniform in their assessment. He was the most consequential Fed chairman in modern history, the central banker who saved the dollar and restored American economic credibility. Federal Reserve Chair Jerome Powell released a statement calling Volcker the embodiment of integrity and dedication to public service. Former Fed Chair Janet Yellen praised his courage and foresight. Ben Bernanke called him the model of central bank independence. But outside the central banking community, reactions were more mixed. Labor historians noted that real wages for workers without college degrees had stagnated since the Volcker recession. Political economists pointed out that income inequality had accelerated after inflation died. Progressive critics argued that Volcker's legacy was the financialization and inequality that defined modern American capitalism. The truth probably lies between hagiography and condemnation. Volcker faced a genuine crisis in 1979, accelerating inflation that threatened the dollar's stability. His aggressive response broke inflation expectations and restored credibility. These were real achievements with lasting value. But his methods imposed concentrated costs on vulnerable populations, industrial workers, farmers, small business owners, while benefits flowed disproportionately to financial institutions and wealthy creditors. The distributional consequences of disinflation remain contested. What's inarguable is Volcker's historical impact. He reshaped central banking globally, established new norms around independence and credibility, and demonstrated that determined policymakers could break even deeply entrenched inflation expectations. Whether future historians judge this legacy positively or critically may depend less on Volcker's choices than on how well his successors balance price stability against other social goals. The Volcker precedent of single-minded focus on inflation was appropriate for the 1980s crisis. Whether it remains appropriate for 21st century challenges is an open question. Paul Volcker's most lasting impact wasn't what he did to the American economy. It was what he taught central bankers worldwide about credibility, independence, and the political economy of inflation control. Before Volcker, central banking was viewed as a technical support function coordinating with elected governments. After Volcker, it became a powerful independent force capable of overruling democratic majorities to achieve price stability. This transformation didn't happen through formal policy proposals or international treaties. It happened through demonstration effects, other countries watching Volcker's experiment, seeing it work, and concluding they needed similar institutional structures. The European Central Bank's design, finalized in the 1990s, was explicitly modeled on lessons from the Volcker Fed. The ECB's mandate prioritizes price stability above employment, unusual for modern central banks and directly traceable to Volcker's legacy. The bank's independence from political pressure, enshrined in European treaties, reflects the conviction that central banks must be insulated from short-term political demands. Germany pushed particularly hard for this structure. Germans, shaped by Weimar hyperinflation, viewed independent inflation fighting as essential. The Bundesbank, Germany's central bank, had operated independently since 1957 and became Europe's most respected monetary authority. The ECB essentially internationalized the Bundesbank model, which itself reflected principles Volcker had demonstrated at the Fed. When the ECB raised interest rates in 2011 despite high unemployment in Greece, Spain, and Italy, critics accused it of Volckerism, prioritizing inflation credibility over human welfare. The ECB defended the decision using Volcker's logic. Maintaining credibility requires resisting political pressure, even when current conditions suggest easing. The Reserve Bank of New Zealand pioneered formal inflation targeting in 1989, creating a system where the central bank explicitly commits to keeping inflation within a narrow range. This framework spread globally. Canada in 1992, Australia in 1992, Australia in 1993, Sweden in 1995. By the 2000s, dozens of countries had adopted inflation targeting. These frameworks formalized what Volcker had done informally, making inflation control the paramount objective and holding central banks accountable for achieving it. The innovation was making the commitment explicit and measurable, which enhanced credibility. The Bank of England's independence in 1997 represented a dramatic shift in British monetary policy. For centuries, the bank had been subordinate to the Treasury. Tony Blair's government granted independence partly because it wanted financial markets to view the UK as serious about inflation control, essentially importing the credibility that independent central banks had demonstrated. Even developing countries, which had historically struggled with inflation due to weak institutions and political instability, embraced the Volcker model during the 1990s and 2000s. Brazil's experience was particularly striking. After decades of chronic inflation culminating in hyperinflation in the early 1990s, Brazil granted its central bank independence and adopted inflation targeting in 1999. The bank's president, Arminio Fraga, had studied Volcker's methods and applied similar shock therapy to break inflation expectations. Chile, South Korea, Thailand, Poland, South Africa. The list of countries granting central bank independence and adopting inflation-focused frameworks reads like a global who's who. By 2010, central bank independence had become the international norm rather than the exception. This convergence represented the most dramatic institutional change in global economic governance since Bretton Woods. Volcker hadn't intended to spark a worldwide revolution. He was solving an American crisis, but his success demonstrated a model that other countries concluded they needed to emulate. The ideological component of this revolution deserves attention. Volcker wasn't simply applying technical economics. He was implementing a particular philosophy about the relationship between democracy and monetary policy. The philosophy holds that elected politicians face irresistible temptation to pursue inflationary policies because inflation provides short-term economic stimulus while its costs arrive later. This time inconsistency problem means democratic governments can't credibly commit to price stability. The solution is delegating monetary policy to independent technocrats insulated from political pressure. This framework, articulated by economists Finn Kydland and Edward Prescott, who won the 2004 Nobel Prize partly for this work, provided intellectual justification for the institutional changes Volcker had demonstrated empirically. But the philosophy contains a profound tension with democratic accountability. If unelected officials control one of the most powerful economic policy tools, what does that mean for democratic governance? How much power should technocrats wield over decisions that profoundly affect people's lives? Volcker himself seemed ambivalent about this tension. He believed central bank independence was necessary, but worried about technocratic overreach. In later years, he expressed concern that central banks had become too powerful and too disconnected from public input. The 2008 financial crisis exposed limitations in the Volcker model. Central banks excelled at fighting inflation, but proved less effective at preventing asset bubbles and financial instability. The Fed, ECB, and Bank of England all failed to anticipate or prevent the crisis, despite their vaunted independence and credibility. Moreover, the post-crisis response, quantitative easing near zero interest rates for years, massive central bank balance sheets, moved far beyond traditional monetary policy into quasi-fiscal territory. Central banks were making distributional choices, which assets to buy, which institutions to support, that arguably required democratic legitimacy. Critics argued that the Volcker legacy of central bank independence had metastasized into unaccountable power. Central banks were deciding winners and losers, shaping industrial structure, influencing income distribution, all without electoral accountability. These criticisms intensified after 2010 as inequality widened in countries practicing aggressive monetary stimulus. The asset purchases that central banks used to fight deflation disproportionately benefited wealthy asset holders, while doing little for workers without financial portfolios. Whether Volcker would have supported these policies is unknowable. He was fighting inflation, not deflation, tightening money, not loosening it, reducing central bank balance sheets, not expanding them. But his intellectual legacy, that central banks must do whatever's necessary to achieve their objectives regardless of political pressure, arguably enabled successors to pursue aggressive, unconventional policies. The developing world's experience with Volcker-style independence has been mixed. Countries that successfully established independent central banks and broke inflation, Chile, Poland, Israel, generally prospered. Countries where independence remained nominal while politicians retained de facto control, Argentina, Turkey, Venezuela, continued struggling with inflation. But independence alone doesn't guarantee success. Russia granted its central bank formal independence, but inflation remained volatile due to weak fiscal institutions and corruption. Indonesia's independent central bank succeeded at inflation control, but couldn't prevent the 1997 Asian financial crisis. The lesson seems to be that central bank independence works best when embedded in broader institutional quality, rule of law, fiscal discipline, property rights. Volcker's success at the Fed depended partly on America's deep institutional foundations, not just his personal determination. China presents an interesting counterexample to the Volcker model. The People's Bank of China lacks independence. It's explicitly subordinate to the Communist Party. Yet China has largely avoided severe inflation despite rapid money growth because the state controls key prices and credit allocation. This suggests that the Volcker model, independent central banks fighting inflation, may be path-dependent working well in market economies with democratic institutions, but less essential in economies with different structures. Looking forward, the Volcker legacy faces new challenges. Climate change raises questions about whether central banks should consider environmental factors in monetary policy. Inequality concerns suggest price stability alone may be insufficient as a policy objective. Digital currencies and financial technology are transforming the monetary landscape in ways Volcker never anticipated. But the core principles Volcker established, that credibility matters, that expectations shape outcomes, that institutions must be insulated from short-term political pressure to achieve long-term goals, remain influential. Central banks worldwide still invoke Volcker's name when defending unpopular tightening decisions. The ECB cited Volcker when raising rates in 2022 to 2023 despite recession risks. The Federal Reserve under Jerome Powell explicitly referenced Volcker's precedent when tightening aggressively to combat post-pandemic inflation. Whether this invocation is appropriate, whether 2020's inflation required Volcker-style shock therapy, is debated. But the fact that Volcker remains the reference point for inflation-fighting credibility over 40 years after his 1979 appointment demonstrates the power of his legacy. The global revolution in central banking that Volcker catalyzed represents one of the most significant institutional changes in modern economic history. Dozens of countries restructured their monetary frameworks based on lessons from his experiment. Central bank independence became global orthodoxy. Inflation control became the paramount objective of monetary policy worldwide. This revolution delivered lower inflation globally. Average inflation in developed countries fell from over 10% in the early 1980s to under 3% by the 2000s. Developing countries that adopted inflation targeting saw similar declines, but the revolution also concentrated power in technocratic institutions, less accountable to democratic input. It prioritized price stability over other potentially important objectives, and it may have contributed to the financialization and inequality that characterize modern capitalism. Volcker didn't intend all these consequences. He was solving a specific problem, American inflation in 1979. But his success demonstrated an approach that reshaped global economic governance in ways still unfolding today. So we've seen how a 6'7" economist from New Jersey engineered the most dramatic monetary policy experiment in modern history, broke inflation that had plagued America for over a decade, and reshaped global central banking in ways that still define economic policy today. The Volcker story resists simple moral judgments. He wasn't a villain who enjoyed causing suffering, but he wasn't a saint selflessly serving the public either. He was a brilliant technocrat who believed price stability mattered more than short-term economic pain, and who possessed the institutional power and personal determination to act on that belief, despite extraordinary opposition. Today, over 40 years after Volcker raised rates to 20%, the American economy looks radically different from the one he inherited. Inflation has averaged under 3% for decades. The Federal Reserve's credibility is the foundation of global financial markets. Central bank independence is accepted as essential for sound monetary policy. But the costs of the Volcker recession are still visible in America's economic landscape. The manufacturing heartland never fully recovered. The good union jobs that provided middle-class security without college degrees largely disappeared. Income inequality, which accelerated during the 1980s, has continued widening. The financialization of the American economy that began after inflation died has created new fragilities and concentrated wealth. Some of these trends would have occurred regardless of Volcker's policies. Globalization, technology, and structural economic changes were transforming advanced economies throughout the developed world. But Volcker's shock therapy accelerated these transitions, forcing adjustments that might have occurred more gradually under different monetary policies. The question that haunts Volcker's legacy is whether the same disinflation could have been achieved with less pain. Economists still debate this counterfactual. Volcker's defenders argue that gradual approaches had failed throughout the 1970s, and that only shock therapy could break deeply entrenched expectations. Critics contend that a more patient approach, perhaps accepting 5 to 6% inflation instead of insisting on 3%, might have preserved more industrial capacity and caused less social disruption. We'll never know for certain. Economic history doesn't offer controlled experiments where we can replay events under different conditions. What we can say is that Volcker made a choice to prioritize price stability over employment, credibility over political survival, long-term institutional health over short-term economic comfort, and that choice had profound consequences still reverberating through the global economy. The real lesson here isn't simply that fighting inflation requires tough measures, it's deeper. Institutions matter enormously. Credibility once lost is exceptionally hard to rebuild, and psychological expectations can become self-fulfilling forces that economic policy must address. Volcker understood that the 1970s inflation wasn't just about money supply or oil shocks. It was about Americans losing faith that stable prices were possible. Once that psychological shift occurred, traditional economic tools became less effective. Breaking the psychology required demonstrating absolute commitment, even at terrible cost. This insight applies beyond monetary policy. Climate change, for instance, suffers from a similar expectation problem. People and businesses make decisions assuming environmental degradation will continue, which perpetuates the very degradation they expect. Breaking that cycle may require policy commitment as dramatic and costly as Volcker's inflation fight. Whether we like it or not, Volcker proved that democratic societies can make painful long-term choices if institutions are structured properly. The Fed's independence allowed Volcker to impose costs that elected politicians couldn't have sustained. This demonstrates both the power and the peril of technocratic institutions. They can achieve necessary but unpopular outcomes, but they also wield unaccountable power over decisions with profound social consequences. The global revolution Volcker sparked, central bank independence, inflation targeting, technocratic monetary policy, represents one of the most significant institutional changes in modern economic governance. Dozens of countries restructured their monetary frameworks based on lessons from his experiment. This convergence delivered lower inflation worldwide, but also raised difficult questions about democratic accountability and the appropriate scope of technocratic power. As we face new economic challenges, climate change, technological disruption, inequality, pandemic recovery, the Volcker precedent offers both lessons and warnings. His success shows that determined policymakers with institutional support can overcome even severe crises. But it also shows that solutions impose real costs, often falling hardest on those least able to bear them. The final paradox of Volcker's career is that his greatest achievement, restoring price stability and Fed credibility, created conditions where his successors faced different challenges requiring different approaches. By killing inflation so thoroughly, Volcker enabled decades of low interest rates that eventually contributed to asset bubbles and financial fragility. The stable prices he fought to achieve made inflation seem like a solved problem, until suddenly it wasn't. In 2021 to 2022, when inflation returned to levels not seen since Volcker's era, central banks worldwide invoked his name while tightening monetary policy aggressively. Whether current inflation requires Volcker-style shock therapy or reflects temporary pandemic disruptions remains contested. But the fact that Volcker remains the reference point for credible inflation fighting over 40 years later demonstrates the enduring power of his legacy. So the question remains, was Paul Volcker a hero who saved the American economy from spiraling inflation, or an architect of inequality who sacrificed workers to protect creditors? The answer, unsatisfying but honest, is probably both. He did what he believed was necessary in the circumstances he faced. The consequences, lower inflation, greater inequality, transformed industrial structure, global institutional change, continue shaping our economy in ways both beneficial and problematic. Whether those consequences justify the costs is a question each generation must answer for itself based on its own values and priorities.